Welcome to Nasdaq TradeTalks, where we meet the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Michael Normyle, U.S. Economist at Nasdaq, Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, and Matt Schulz, Chief Credit Analyst at LendingTree. We are here to discuss the 50 basis point rate cut that the market has been anticipating and what that could mean for consumers, lending, and the overall economy moving forward. It is great to see all of you. Welcome back to Trade Talks, Matt. So we got this 50 basis point rate cut, right?
Yeah.
Could have been 25, could have been 50. How do you think the market, from initial reaction, is digesting this?
Well, I think that, like you said, it was kind of built in a little bit, but I think the bigger question is how the consumer is going to look at this. And I think any break that the consumer can get off of interest rates being at their all-time highs and just rising for 2 years, I think is going to help. And I think it's going to at least make people feel a little bit better about things. Not sure whether it's going to make people want to go out and spend more. We'll have to see. But I do think that for consumers, it's a positive thing.
Yeah. Well, Michael, let's think about it in these terms. From the debt side for the consumer, 50 basis points, is that going to move the needle enough to free up cash? Will they use that to pay off debt, or will it be put back into the economy? Again, we're coming up into holiday season here. Is this enough to move the needle?
Yeah, in reality, it's 50 basis points on its own, 25, same story, really isn't going to move the needle a ton, but it's really the signal that we got from the summary of economic projections showing that more is to come and that the direction of travel is clear from here. So I think if we're looking at this in a vacuum, say the Fed just did 50 basis points, no more cuts happen from here, which obviously is not the expectation, but that's not going to do a lot for people. But if it's the 200, 250 that the SEP suggests that we get over the next couple of years, that's where it really will add up and help with that spending, help unfreeze the housing market, those types of things that really get spending going into all different areas of the economy.
Yeah, and Chris, that really is the question, because we know that consumer makes up 70% of GDP, and it's been really hard to bet against the consumer. Granted, It's been credit driven, but you hear from consumer issuers, Nasdaq listed companies all the time.
Right.
Give us some perspective.
So, going back to the macro theme here, there's a few things that consumers are concerned about, and we were just talking about before, whether or not they're going to lose their job, how much money are they making, and where that money is going to be spent, whether it's going to pay off debt or other items, and 3, will they be able to continue on that path and prosper? So, companies are taking that data in, and if you look at the retail sales, CPI data, PPI data, unemployment, JOLTS, pick your poison, right? It's showing you a softening but not weak labor market. It is showing you that wages are rising and at times keeping pace with inflation, but not always. Yet the debt continues to rise, and if you look at how inflation has risen over the last 3.5 years since COVID, it is still a baseball bat to the face for a lot of consumers. They're not used to that. So how will they continue to grow? Consumers have been trading down over the last couple of months. The lower end has been doing without. On a number of items, dollar stores thought they were going to pick up a lot of that, and they didn't. A lot of them are trading at 52-week or lows, if not lower lows than that. And then the haves are the ones that have a nice broad mix, whether it's brick and mortar and online, staples versus discretionary, and those larger two retailers are doing very, very well. And then the one-off stores, the Burlingtons, the Ross stores are all also doing very well, and everyone else is mixed in between. So depending which bucket of consumer you're looking at, they're still doing okay, especially on the higher end, because you have investments, you own your house, your mortgage is at 3.2%, and you have money to spend because your wage is keeping pace with it. Middle class is trading down, but they're still doing, but they're not doing as much, and some are doing without. Back to school is okay. And then the lower bucket is really where a lot of the money is not being spent because the stimulus checks ran out and a lot of other items. A half a point, basis point cut, whether it was this month, next November, or December, doesn't matter because, as Mike said, a full point was baked in for the year. How it comes is just really kind of arguing about the data points. The question then comes, though, and this is where we're seeing some of the issuers show concern, is will the consumer continue to spend coming into Christmas? And if so, where will they spend and how will they spend?
Right.
So that's kind of an interesting point. Earlier we were talking about credit cards, and you
let's look at some credit card stats here that Matt has pointed out. If you owe $5,000 on a credit card with a 24.92% rate and pay $250 each month, it takes you 27 months and $1,528 in interest to pay the balance off. Now we have the 50 basis point cut, right? you're saving $1.50 a month, somewhere around there. I mean, is that really going to change the calculus in terms of how you're allocating your spend?
It's really not. It's nice. I mean, they'll certainly take it, but it's not really going to change the calculus. And what it's really all about is, like we've talked about, the messaging of more cuts coming and people at least being able to see a little bit of a light at the end of the tunnel. Whether that's going to make people want to spend more in the holidays, I'm not sure. I think that a lot of Americans are still really beat down by inflation, and a lot of the messaging about inflation being down misses the point that lower inflation is still higher prices, and people are still
relative to where we are year over year. Doesn't mean from
to
2019 to
like a couple years ago,
Right.
and just that adds up to just a general feeling of ick among consumers, for lack of a better word.
Are we seeing continued improvement in inflation data year over year at least?
Yeah, there's definitely been some progress there. Like you're saying, though, it's still positive inflation. It's just slower inflation. And so, the thing really holding it up still is housing. That's been the one kind of sticky piece that we've had. We've seen the core services, the other kind of sticky component, core services excluding housing. If you're looking at it on a shorter term kind of annualized basis, that's back to 2%. Core goods inflation, that's negative actually, or close to zero. And it's really housing that's still it's above 2%, but it is trending lower. The forward-looking kind of market-based data suggests that we'll keep seeing it trend lower. But, like you're saying, its prices are 25% higher than they were, 4 years ago, and people don't like inflation. The issue with the trade-off for consumers, if you think about inflation, people don't like it because it affects everyone. If we have a higher unemployment rate, a really bad recession, it's 10%. So 1 in 10 people are impacted versus inflation impacts everyone. So it's a big problem for consumers.
What's the adage? If your neighbor loses their job, it's a recession. If you lose your job, it's a depression. Right? So that illustrates your point. But Matt, I want to go back to you for a moment here. You pointed out that you have more power over your money than you realize, regardless of what the Fed does. I feel like we hear it more. It's a headline grabber. Clearly, we understand how the media model works, right?
Yeah.
But you do have more power despite the headlines.
Yeah, I mean, regardless of anything the Fed did today, or frankly is going to do in the next year, you can make more of an impact on your credit card interest rate, for example, yourself. The 0% balance transfer card, personal loan, and you can even call your credit card issuer and ask for a lower interest rate. We've done studies at LendingTree forever. They've shown that about 3 out of every 4 people who ask for a lower interest rate on their credit card get one, but too few people ever ask. And the average reduction that people say they get is about 6 percentage points, which is way more than the Fed's going to do.
Right. Well, Chris, all right, let's use a professor analogy here since you are a professor of finance. We'll give you the shout out there. It's almost like I'm running late in my assignment, Professor Dearborn. This is why. Can you give me another day? As long as you know and you're willing to work with your students, it's essentially the same premise.
Right. 6% is interesting by calling, and that's a much bigger bump than you're going to get, period, across the next tightening
Well, let's hope so. You don't want it to fall that much.
Right?
Yeah.
When you look, going back to the dot plot, all right, I looked at it quickly, you've got it there. 2%, 2% is where they want to get, 4.4% give or take over the next 2 meetings, and then only another full percentage point over that time frame. Is that enough time to really make an impact? Will that loosen up the housing market? Will it loosen up auto loans a little bit? Will it help people who are already paying and getting into troubles with their credit card debts, defaults on autos, and credit cards are back to where they were in 2018, right? Is that going to make a difference, or is that going to just tell people to go out and spend more? So to your point, as long as I know that it's coming, I will work with you, but I don't know what's really coming. I assume what's coming.
I bet your savings rates go down
100%. But you know what the market's like?
Amazing how that works.
Yeah.
You know what the market's like today? We're up on the news, right? The 210 spread is, positive again, first time in 25 months over the last couple of weeks. The dollar's getting hit as it should. So you know what's coming. I don't know if it really moves the needle. The markets are already at all-time highs. I think we're still going higher.
Right. Well, Michael, do you think that the Fed has executed on this strategy well, regardless of the market. Market and economy are two different things. Do you think that they executed at the end of the day relatively well?
I think they handled it the best they could. I think this is sort of a tacit admission that July was a mistake and they should have cut then. And that became pretty clear within a few days where we got that jobs report that was pretty weak and has since been revised lower. And also saw the SOM rule triggered with the unemployment rate rising. So I think this is just saying, okay, we missed our chance in July. We're catching up now, all done in one meeting. And now we're going to go by that kind of gradual pace from here where we can really fine tune things. So I think having missed the boat a little bit in July, this is the best they could do.
Well, Matt, you were talking about stimmy checks before, and at the end of the day, I mean, the Fed doesn't have a benchmark in terms of how you navigate an economy out of a pandemic. I mean, clearly it's different than the 100 years before that we had one.
Right.
There is no roadmap for that. I mean, we were able to, you know, how did we, this in the 80s, when we had moves in the 90s, we can benchmark it to something. This is new territory for them.
Yeah, and we did see during the pandemic, we did see that people really put an effort towards paying down their debts when they had it in a really significant way. And I do think that there's reason to believe that people may end up trying to put a little more toward the debt that they have now if interest rates come down a little bit. Certainly if we see what we're expecting to see in the next 6 months to a year, I think that people will work on paying that debt down a little bit. There's always going to be people who see it as a reason to go spend too, but I do think that it will help trigger some folks to work more to pay down.
Well, I mean, there is recency there, and you hope some lessons were learned from the pandemic, how quickly jobs can change, right? And that
For sure.
demographic needs the paycheck more so than people who are fortunate enough to have a 401k, money in savings accounts and so forth. So hopefully the recency bias will be there. You know, because again, if things were to, you know, trajectory changes to a downward move in the economy, can, you know, cost of capital if it gets more expensive, if tax policy changes for corporates, you know, it would behoove you to not have a heavy balance sheet.
Yeah, and I think that's really kind of what it's all about, is people being a little nervous about the job market. And just feeling a little uneasy, hearing about their friends getting laid off and stuff like that, and maybe not wanting to spend as much. So I think that might be making some people nervous in terms of not wanting to spend until they feel a little more confident about the economy, their own personal situation, and the election, and 3 million other things that are happening.
Well, I mean, but to your point, though, you do have some sort of control over it. It doesn't have to be such a dire situation. And again, hopefully recency, Chris, has taught us some valuable financial literacy lessons.
Some. Not much.
We talk about this all the time. Liquidity is one thing, but there's different forms of liquidity. You don't want the credit side of the equation to be higher than.
There's a saying, right? Stocks aren't companies, and companies aren't stocks, and it goes to the same for the consumer as well. Right. Having access to credit doesn't mean that you have to use the credit, and spending that credit on something does mean that you will have to pay it off. But a lot of times people will just extend that. You know, to some of the stats I saw that you put forward. You know, $5,000. You know, and a half a point, even a full point, really doesn't make that much of a difference over a 1 year period, right? And the amount of interest you're going to be paying on is still substantial. So the markets are still going to go higher because people want to invest. Now, all of a sudden, bond yields are churning a little bit. You're not going to get as much on your interest rate on your savings. So 2 years, CDs, et cetera, is going to start to roll over. Where are you going to put money?
Well, that's been the thesis, right? All this money that's on the sidelines once rates come down.
Yeah.
Right, and that money, where's that money going to go? Now that you have a clearer path, there's only really one more obstacle on the way, and that comes in the beginning of November. And once that path clears on the election, you'll probably see investment go to whichever party wins, to the stocks that are going to benefit the most in whichever sectors they are, and that rotation will take place. That's where you're going to see money put to move. Right now, it's people positioning themselves. They're going to take some short-term profits here based on what the market has just done. All the indices are popping right now as the dollar sells off, as it should. You know, and take a look at where the 10-year yield goes. That'll tell you where the market's going. 10-year yield and the market are finally, again, correlated together where they should have been, but haven't been because we've been in a zero interest environment for way too long.
All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.